Hello and welcome to the Morningstar series, Why Should I Invest With You? I'm Emma Wall and I'm here today with Simon Evan Cook, manager of the Premier Multi-Asset Growth and Income Fund. Hi Simon.
Hiya.
So your fund is a bit of a one-stop shop. You're doing what most investors are trying to do, which is blending funds from different regions, different styles, in order for an outcome. And the fund we're going to talk today about is the Growth and Income Fund. And in particular, because we're doing an Emerging Markets Week, I thought we could look at how you blend the emerging markets part of that portfolio with everything else. I know that you have been avoiding China, so maybe we should start there.
Yeah, that's a really good place to start, especially at the moment. You know, at the time of us talking, China seems to be crashing around everyone's ears. It's had the incredible bubble-like rise on the way up and now seems to be coming off at just the same pace. So we have avoided direct exposure to China. And what I mean by that is we haven't bought any A-share trackers, for example. The reason being that it looked very obvious to everyone outside of China that that was a bubble and that was going to end quite messily. And that seems to be what's happening. What that doesn't mean is that we don't have any exposure to China whatsoever, because we are very, very firm believers in active management. So we have highly active funds in Asia and emerging markets, which will have exposure to A shares even, or H shares, so the Hong Kong listed shares. But they will be very, very specifically picked stocks, picked because they're great companies or they are decent companies at a great valuation. Now, what that means is, at a time like now, when there's a lot of effectively babies being thrown out with the bathwater, it means that those fund managers can pick up the stocks that have been unfairly hit while avoiding the ones that you should never have touched in the first place. So dislocations like we're seeing currently, as far as I'm concerned, are good news. And
with fund management, indeed with any kind of investing, whether you're professional or private, it is as about avoiding the mistakes as it is about picking the winners, isn't it?
Absolutely, yeah. I think the best way to make money in the long term is not to lose it in the first place. And I see exactly that. The active managers we lose, I don't see them so much as being able to find that great 10-bagger stock that's going to go through the roof. I see them really, their primary function is to look at the market and then to get rid of the rubbish that's underneath, to get rid of those companies that are too expensive or those companies that are badly run or over-leveraged. Once you remove all that, then you're going to outperform the market anyway, certainly over the longer term. And so that ability to do that is exactly what we see from our active managers. And
talking about things that don't do well, contrarian investing takes advantage of those things that have not done well in the past. And I know, you know, it's very emerging markets focused, but commodities is one of the things that you're starting to look at again, because it's just been such a dire 3 years.
We are, yes. So, I mean, to give you the history of that, we looked at commodities, or commodities were very popular about 2 or 3 years ago. We looked at how they'd done over the decade before, and they were at the top of every performance table you could possibly imagine. It was by X fund or X gold fund or whatever it may be. And that puts us right off. So the contrarian bent goes both ways, from avoiding and getting involved. But now you fast forward 3 years and those same funds are at the very bottom of every 10-year list. So that's starting to get us interested again. We're talking to active managers because, once again, we want active managers there, because I'm sure there are companies that will go bust, but we want an active manager to keep us out of those, which you wouldn't get if you bought the index. But the fact is that they're so reviled now, the hot money seems to be long gone. And if there's one fact we do know, it's a better time to buy them today than it was 2 or 3 years ago. That doesn't mean we've bought in yet, but we are looking at them a lot more closely. So it's just an example of how we view the world and how we operate.
So positive on Asia, negative on overvalued US equities, and
yes,
starting to look at commodities.
Yeah, that's very fair. US equities, we have been underweight for quite some time. Happily, that hasn't affected our performance. We've still performed very well. The reason being they've looked expensive all through the current rally on a long-term basis, but that hasn't stopped them from rallying. So we may have got something wrong there. We have to hold our hands up and have a look at it again and see, is there something we should have done better? But that doesn't mean correcting that mistake by rushing after them now. And what we're seeing now are valuations, certainly on a cyclically adjusted basis, that are at the peaks you saw in 1929. Not quite at 99 yet, but above every other single peak you've seen. And that, to us, is not a great time to hold an asset class.
Simon, thank you very much.
My pleasure. Thank you.
This is Emma Wall from Morningstar. Thank you for watching.